The trend of rising interest rates has been one of the most important macroeconomic themes of the past few years. However, the effects of interest rates on different asset classes, investing, as well as the portfolio companies is not always well understood. In this video, I'm going to try to articulate some of the more intuitive impacts of interest rates on private equity as a whole. My name is Ting for Peak Frameworks, and let's dive in. As I'm thinking through these different effects, I often like to think of the weighted average cost of capital formula. And if we look at the weighted average cost of capital formula, we can see that two of the major inputs are cost of debt and cost of equity, both of which are impacted by the interest rate. Now, if you're not familiar, the weighted average cost of capital, or WACC, is one of the most fundamental corporate finance formulas that informs pretty much all modern valuation, at least on a theoretical level. So the first thing that I think is most obvious is that interest rates rise, that means the cost of debt rises. Now think of what happens if cost of debt rises. If I'm a private equity firm and I use a lot of debt to acquire a business, that means the increasing cost of debt is going to reduce the amount of debt input on a business. If we think of a potential company, the amount of interest that it can handle is going to be static. So that means if interest rates rise, which is what we have to pay on the debt, then the absolute amount of debt that we can raise is going to be lower. So debt multiples are going to go down. And the direct result of that is the levered returns that we can get on these investments are going to be lower. So all else being equal, if we have two identical LBOs and one is using less debt, the one that's using less debt is going to get worse returns. Now, there are, of course, a lot of other factors that go into this, like negotiations, finding better deals during times like this. So it's not a blanket statement that returns are going to be worse, but it definitely makes it harder to get a return purely on raising debt. Now, another big piece is that interest rates make other asset classes more attractive. Things like bonds, as well as high yield credit and even cash, all become relatively more attractive when there is some return to get on interest rates. When you're in a low interest rate environment and the return on cash is like 0%, you're not very incentivized to hold a lot of cash, and that's why you might chase yield wherever you can. However, when interest rates are higher, a lot of investors might balance their portfolio and put more money into credit or bonds or some other kind of debt with interest attached to it. This is often why we see interest rates affect public stocks so much, because there's an outflow of cash from these investors into other asset classes. If we look at the TMT space or fast growth healthcare, we might see that their valuation multiples have decreased a lot as interest rates increase. And again, we can think about the weighted average cost of capital. These fast-growing businesses, a lot of the cash flow is predicated on future growth. We're talking about growth maybe 5 to 10 years from now. And the higher the interest rate is, the higher the discount rate is. And that means the value of those future cash flows is going to be lower. So all that to say is that interest rates also create more demand for other asset classes, which in turn is going to put more pressure on private equity. Now, the third factor, and the last one we'll talk about, is the economic impact to portfolio companies. If you're a private equity firm, you're going to own a bunch of different portfolio companies. And now all of these companies are going to have a harder time raising money and raising capital. And that's because the cost of capital has increased to them as well. If they wanted to expand into a new geography or raise money to start an entirely new business unit, it's a lot harder to do that when interest rates are higher. So if you're a private equity firm and your portfolio companies can't raise money as easily, potentially the revenue growth could go down, or they have to be much more conscientious about their growth in general. And that could also impact your returns, as the EBITDA of your portfolio companies wouldn't be growing as much. So those are some of the most intuitive things that will happen in a period of rising interest rates. If you are interested in breaking into private equity, learning about the modeling and recruiting, you can go to peakframeworks.com to check out our course. That's it for this one, and I will see you in the next video.